morning and welcome to our first New Year edition episode of Wealth Building Wednesday. Wealth Building Wednesday is an opportunity for us to talk to the experts about all things financial. So we are looking forward to a great show today. Wealth Building Wednesday is brought to you by TRHT Selma. TRHT stands for Truth, Racial Healing, and Transformation. One of the things that we work very hard to transform in this community and abroad is our financial status. Y'all know the wealth gap does exist in this country we call America, and we want to help close that wealth gap by giving you information that is practical. And listen, we want to put it where the goats can get it, honey, so everybody can understand what is happening. And our guest today is going to help us understand. Oh my goodness, for me, it's a curse word, but income taxes, right?
Yes.
Tiffanie Martin, owner of MDC Premier Tax Solutions. So welcome, Tiffanie.
Thank you for having me.
Absolutely. And I was just telling you before we went live that you were doing these educational videos. You do educational videos about tax preparation and what people, the ins and outs, things that people should be looking for. And I said, oh, I wonder if she would do a Wealth Building Wednesday episode. So I was so excited when you said that you would join me for an episode. So this is going to be informative. If you have not yet filed your taxes, if you know people who have not yet filed their taxes, please make sure that they are logged on, tuned in, and that you share this information. It is live, broadcasting live on the Selma Center for Nonviolence, both Facebook and YouTube channels, as well as with the Black Belt Community Foundation. The Black Belt Community Foundation and the Selma Center for Nonviolence are the TRHT partners here in the city of Selma. So we can get started. Listen, with the first question that I have for you today,
Yes.
is what exactly are income taxes and who has to file them?
So income taxes are taxes from income that we actually receive. So it can be earned and unearned income. And we have to pay our taxes on that money that we receive.
Okay. And so now everyone has to file?
So basically, individuals in general have to file. Dependents can actually file. And those are certain children that's up under the age of 19, or they are actually full-time students. People that are self-employed that makes over $600, they have to file income tax returns. And it says aliens. So those are the individuals that have to file. And there's actually a publication that actually goes in reference with this, and it goes as far as the threshold to say if you make a certain amount of income, then you have to file these taxes. And it's publication 501.
Okay. So publication 501, and we can just simply Google that IRS publication 501 to figure out if we actually are in that group that needs to file.
Yes, exactly.
Okay. Awesome.
So basically,
Go ahead.
it says like if you're single and you're under 65 and you make at least $13,850, then you have to file 65 or older. If you make $15,700, you have to file. And if you're married filing jointly and you're making $27,700, you are actually one of those people that are required to file. If you are married filing separately and your age, any age, if you're married filing separate, even if you make just merely $5, you have to file.
Wow.
Yes. And then head of household, you have to file. If you're 65, under 65 is $20,800 you have to file. Okay. If you're 65 or older, it's $22,650. And also the qualifying surviving spouse under the age of 65 is $27,700, or older is $29,200.
Wow. Okay. So that is honestly, it sounds like the majority of us really are in the number of folks who have to file income taxes. So make sure, y'all, that you know whether you need to file or not.
And also, too, sometimes if you paid into federal income tax and there were actually federal withholdings actually taken from your income, then it's just
Hmm.
a good idea to go ahead and file anyway, because if you don't file, then it could mess you up when it comes to retirement, because you know that your retirement is based off of like the amount of money that you receive, the years that you worked, and all that pretty much goes
Hmm.
hand in hand. So you just want to make sure that you're filing accurately.
Okay. So that is great information for us to reference and to know whether or not we need to file income taxes. I want to talk about as well, to ask you about dates that we need to be aware of. So if we are filing specifically when it comes to folks who are expecting an income tax return, right? So while
Mm-hmm.
we all have to file income taxes, all of us don't receive a return. But if we expect to receive an income tax return, which means you get money back, look,
Right.
are there some dates that we need to be aware of?
Yes, and those dates pretty much is April the 15th if you actually are owing. However, you can do an extension and get a 6-month extension, to whereas it can extend the amount of time that you actually have to pay um those taxes back. So they actually give you 6 months where you can do an extension. However, Lydia,
Mhm.
people that do not are are expecting a refund, they can
Mhm.
actually wait 3 years. It's a 3 year
Really?
window. To whereas they can, yes, it's a 3 year window. So if you have not filed your taxes within the past 3 years, then now is actually the time, because otherwise you pretty much forfeit your return, even if you are due a return.
Oh, wow. Okay, so
Hmm.
now that is really great information to know. So if you expect an income tax return, you have up to 3 years in
Hmm.
order to
That's
file
if
it, but
you're
they need,
due a
if you're
refund.
due a
Yes.
return. Okay.
Hmm.
Okay. Awesome. So wow. If you have money that the IRS will owe you, honey, you better come on and file,
Hmm.
file your taxes, because it's the government. They'll take it back. Y'all know that. Look.
Yes, they will take it.
So, what about the difference between the taxpayer classifications? Like, I know we were talking prior to going live about, say, folks filing head of household who aren't actually head of household. Like, so what is it? What's the different meanings behind these classifications? Like, if you're single, single head of household, married, married filing jointly, married
Hmm.
filing separately, are there different advantages that can be afforded if we are married and file separately? Or yeah.
So actually, if you filed, when it comes to being married, they actually go off of the last day of the year, what your status was. If you were married, of course, they want you to file married filing joint, because you would get more advantage if you file married filing joint. If you file married filing single, then a lot of those credits you won't be able to file. However, if one individual or one spouse claims um, married filing separate, then the other spouse actually has to file the same thing that the
Okay.
other spouse filed, because what'll happen is their taxes will get held up. Um, and they pretty much don't want to do that. But I know that some people, spouses actually say, well, I don't want my spouse, I don't want to incur the debt that my spouse has. So they don't want to file together.
Hmm.
However, if this actually happens, then the spouse can actually claim the or file for the injured spouse, and they won't have to take on that responsibility
Oh, wow. Okay.
and that debt. Well, also too, when it comes to head of household, you have to actually be taking care of the household at least 51% or more in order to
Okay.
claim head of household. They actually have to have a dependent as well to claim head of household. So if you guys are receiving some type of government assistance, like Section 8, and Section
Hmm.
8 is actually like covering majority of your rent, then but if you are receiving other income, you have to let your taxpayer know like everything that you are receiving, because it has to equate to over percent, which means 51% or more, then you can claim this head of household. However, if you're living in government quarters and you're living up under someone else, then you
Mm-hmm.
cannot claim head of household. However, I can claim you as single with the dependent, and then you can still be able to qualify for certain credits up under this classification. And two, I don't know if a lot of people know, but even if you are married, Lydia,
Mm-hmm.
and you have not lived with your spouse for 6 months out
Mm-hmm.
of the year, the last 6 months out of the year consecutively, then
Mm-hmm.
that person can actually claim head of household too if they have a dependent.
Okay.
But they have to have that qualifying dependent in order to still claim head of household in this situation. And then there is the qualifying widow, and you can do that for up to 2 years after your widow has actually expired.
Oh, wow. Okay. And so now this is excellent information. I'm so glad that you shared with us the definition of what it means to be a head of household, because that's a classification
Mm-hmm.
that we hear tossed around a lot. But if you
Mm-hmm.
aren't actually, per what you just said, if you aren't actually covering at least 51% of that household's basic like operation, then
Yes.
you can't fairly file as head of household.
And that's correct. And so a lot of times too, people file incorrectly when it comes to this, and this
Hmm.
can actually trigger an audit
Okay.
with the
Now that
IRS.
is really
Yes.
a dirty word. So what does it mean if someone is audited?
So they actually have to justify or substantiate that they actually can claim this classification. And so
Okay.
if they are found not qualified, then they can actually have to end up paying the money back that they actually received from the income tax. And
Okay.
also, they can be disallowed this credit from 2 to 10 years. So if it's just a mere mistake, then it's
Hmm.
just two. But if it was actually considered fraudulent, then you can be disallowed this credit for 10 years. And I know that a lot of people really need to claim this credit. So it's
Hmm.
imperative that you do your due diligence and when it comes to your tax preparer, and also that you provide accurate information to your tax preparer to make sure that you are not put in this situation.
So now you're saying that we need to make sure that we do our due diligence when it comes to identifying who the person is that or the company that we're selecting to prepare our taxes, but also give the right information, y'all. Like that's
Yes.
important, right?
Hmm.
Included in that, what about folks who we gotta talk about it, who let's just say pay other people or get social security information for children who they are really not either the parents of or have the financial responsibility for. Does that pose a problem in any way? I mean, I know folks are really just trying to increase their refund, but
They are trying to increase their refund, but at the end of the day, just get what's due to you.
okay.
And I say that because a lot of times people are receiving Social Security, people are receiving food stamps, people
Hmm.
are also receiving other government assistance. And so when they do this, and there's a system that's connected from the IRS to these other government agencies, and so you can end up losing your benefits when it comes to this. And when it comes to you actually proving whether or not this child is actually in relation to you, in
Hmm.
relationship to you, they may ask for birth certificates, they can ask for documents from the doctor's office, they can ask for school records. And so when you go to file and you come up on an audit, these are the type of documents that they are requesting for you to actually say that this person is in some type of relationship to you. So they'll say, oh, well, this is my niece, and then there's no relation to that. And then the person can actually end up losing their benefits. And, if you're
Wow.
on Section 8 and then you're paying only, I don't know, I'm just going to throw a number out there, $100, and then you turn around and then now your rent is actually $400, and that can be the reason. So like I said, it's just make sure that you actually provide the accurate information to the tax preparers that's actually preparing your tax return. Don't just try to say, oh, well, I'm going to allow this person to, put whatever on my tax return, and then it can actually mess you up in the long run.
Mhm.
Because, I mean, you may get an extra, $2,000 for this, but that's only temporary. It's
Right.
only temporary. It's only going to go so far. But you know your situation better than anyone. So therefore, just make sure you provide the accurate information so you can maintain your government assistance.
Okay. So now, when it comes to the credits, because the having children and filing with children on your income tax return is actually connected to the child tax credit. And
Hmm.
so what is the earned income credit and who's eligible? And then also what is the child tax credit and who's eligible for that?
Excuse me. So when it comes to the earned income tax credit,
Mhm.
the key word is earned.
Okay.
So it can't be from your pensions, it can't be from social security, it can't be from child support or unemployment benefits. It actually has to come from your wages, your salaries, your tips. um like even if you just was running errands for someone, and or if you just you were a taxi service
Okay.
and you actually help that person, so that can be considered a job and that's income. So basically the IRS wants you to report all income regardless of what income it was that you received. And you as long as you have earned income in there,
Mhm.
then you can qualify, but also there's a threshold. So
Okay.
if you make over, I think it's 42,000, Lydia,
Mhm.
then you can qualify. Also, too, people that are at least 25 years or older can
Mhm.
actually qualify for earned income credit as well, as long as they meet that threshold.
Okay. Okay. So what about the child tax credit? What is that
So,
about?
so when it comes to the child tax credit, they have to be eligible, of course. The child must be at least 16 years of age by the end of that tax year. They have
Okay.
to be a U.S. citizen. The tax payer must have paid more than half of the income when it comes to taking care of this child. The dependent can't be claimed by anyone else, and or they can't provide more than half of their income. As you know, a lot of times, like kids work and things like that or whatever. And so
Mhm.
sometimes you have to, just dig a little deeper, like I said, and do your due diligence when it comes to who is actually preparing your taxes. So that way you can get the right credit. But when it comes to the um the maximum AIG,
Mhm.
for somebody who's actually filing a single head of household or a widow, if you're actually claiming just like you don't have one child or whatever. Remember, I said that some people can actually get this and then they don't
Mhm.
have to have a dependent, just as
Mhm.
long as, it's $17,640.
Okay.
If they're single head of household or widow with no dependents. But
Okay.
if they actually have one dependent, then it's 45,560, and then two dependents is 52,918, and then three it goes up to 56,838. And on top of that, for every no qualifying child or whatever, then you know that you can get at least $600 or up to $600, and it goes from there. But there's also a chart on this, so everything that we're discussing today, Lydia, you can actually go on the IRS
Okay.
website and you can find out all of this information.
I am so appreciative of you for mentioning that. A lot of times, many of us, including myself, when we hear the term IRS, it's like, oh my God, because it
Mm-hmm.
feels, very heavy. We know that there are penalties that we can face,
Mm-hmm.
if we aren't filing on time, if we're not paying our debt, if we owe the IRS, or, depending on your income, you don't want to know that you owe, right?
Right, you don't.
So And so we can kind of avoid the situation, if you will, but sharing the fact that you are getting this information directly, or that we can actually get the information directly from the IRS, means that we as individuals, when we come to you as a tax preparer, we can actually engage in the process in a more educated way. And the fact that
Mm-hmm.
you're willing to take the time to educate your customers.
Yes.
Again, when I saw you going live and talking about these things, I was like, see, that's what I'm talking about, honey. Tell the people
Mm-hmm.
what we really need to know when it
Mm-hmm.
comes to income taxes, because it's so important that we are informed.
So I want to share something else too.
Mhm.
A lot of times people are in situations to whereas there is, excuse me, to whereas a child is living with a father,
Mhm.
or the child is living with the non-custodial parent or the custodial parent. Um, and in order for the non-custodial parent to actually claim this child on their taxes for EIC purposes, or the child tax credit,
Mhm.
or the additional child tax credit, um, then they have to file this form, and the form is called 8862, and that's giving the other individual permission to actually claim this child and to get these credits. So one
Okay.
parent can actually get the EIC, and if the
Okay.
child is actually in daycare and
Mhm.
they're doing some type of dependent expenses
Mhm.
with daycare expenses, then the
Mhm.
other parent can actually claim the dependent expenses on their return.
Okay. And again, you said that is form 8862.
8862. Mm-hmm.
Okay. And both parents need to fill that out.
So the custodial parent can fill that out and actually give
Okay.
it to the non-custodial parent to claim that child on their tax return.
Okay. Then now that's great info, really great information to know. Wanted
Mm-hmm.
to ask before, because I know we only have about 8 more minutes. Wanted to ask about tax write-offs. What are
Mm-hmm.
write-offs, and are there examples that people can use as tax write-offs who don't own a business?
So write-offs are actually deductions,
Mm-hmm.
and a deduction is an expense that you can deduct from your taxable income. So basically, when it comes to taxes, that's what we're looking at, that taxable income, and it's saying exactly how much your tax liability is when it comes to the amount of money that you have made for the year.
Okay.
So what you do is you take that amount and of the expenses and you subtract it from your taxable income, and so essentially, those tax write offs will help you pay a smaller tax bill, or,
Mm-hmm.
it could say, hey, that you're going to get a refund, or it could lower the amount of money that you actually owe to the IRS. But if you don't own a business or anything like that, like you can actually get a write off for your property tax if you have some type of mortgage, interest, student loan, if you've made a contribution to charity. So just make sure that you actually get proof of these things.
Okay.
When you have mortgage, then you get a mortgage statement at the end of the year. If you have student loans, you get a 1098T form, to whereas they actually supply you with these documents at the end of the school year for you
Okay.
to file. But there are also other credits like healthcare credits in case you are traveling back and forth. Like, say, for instance, since we're from Selma and you have to go to Montgomery, you have to go to
Mhm.
Birmingham, wherever, you can put in those expenses from you having to go back and forth between the doctor's offices. So those are called healthcare credits, and then you actually can do the homeowner credits. So if you have did any type of updates to your house, if you have benefit from these things, because if you go and you got 15 windows in your house and you're actually
Mhm.
trying to get a credit for every window. That's not going to work, you know. So it's only like $2,600, $2,400 that you can actually receive, Lydia. And so you
Okay.
just want to make sure that you're being strategic about it. So you may be only to do, you know, one window this year and then another window next year or whatever, because you're trying to actually save instead of having to pay out so much money to IRS.
Absolutely. So those are some really good tips that we need to keep in mind, especially in this season where a lot of us have experienced storm damage, you know, and families are still recovering. If there's some things like you said, window replacement or
Right.
what have you, that can be done in a strategic way. If it's not an
Mm-hmm.
immediate, you know, I've got to get it done now, then there's some savings that can come your way when it comes to your income taxes. So now I want to ask you about PPP. Now look, that thing. We have more small businesses in Selma, baby. When I tell you, the people, the folks that filed and
Girl,
received,
Selma were booming with them PPPs. I was like,
yeah.
oh my God, like, hey, but um it blew me away, Lydia. But on the other hand, when it comes to the PPPs, like that's no longer in existence right about now.
Mhm.
That ended
Right.
with the last tax year. And
Okay.
so some people were actually given a forgiveness when it came to that.
Okay.
But it didn't really affect, you know, anything when it comes to your taxes. You just had to report, you know, that you actually received it.
Okay. And so I was wondering because I know that with the COVID shutdown and people receiving those funds, you know, the IRS is definitely connected to other federal programming. And
Yes.
so, is there a way for people who say may have received like Section 8 benefits? You know, if you are a part of a HUD program, a USDA program, and you're saying that, okay, I
Mm-hmm.
had a business, I should have been earning $100,000. And it's like, okay, if you're supposed to earn $100,000, why are we paying anything towards your rent?
Exactly. And so
Um,
actually, Lydia, that some people their rent has increased. Some people have actually lost their housing because they were saying that they received this money. You know, you made $60,000 or you made $100,000 in order to receive this PPP loan, and it wasn't you wasn't actually qualified for it, but you allowed this person to file this for you, and then
mhm,
now, you know, hey, it has affected your benefits. So, like I said earlier, just make sure
mhm.
that you are doing what you need to do as a tax payer in
Okay.
order to keep your benefits if you are in need of those benefits, because filing taxes or filing for some of these other loans and stuff, it can affect you.
Wow. Okay. And certainly, last but not least, and I know that you've been dropping the nuggets along the way, but wanted to just check in to ask, you know, what are some of the most important things that we need to remember as folks who are filing taxes when it comes to getting ready for you? Like, so if I'm getting ready to come to your office, what do I need to be mindful of?
So basically, you need to make sure that that person is actually has a P10, and that's a number that the IRS identifies you when you file taxes. So, excuse me, Lydia, but you have to have that P10 in order to file people taxes. So a lot of times people file taxes and they don't have a P10 and they're considered a ghost preparer. A ghost preparer, you would know because you at the bottom of your tax paper, it'll say that you self-prepared your own taxes. When you know for yourself that you actually paid someone to file your taxes. So if anything comes back, it's not on the person who filed, it's on you. So just make sure that you actually sign all of your documents. Make sure that you actually receive each and every document. And it's not just the first 2 pages when a person gives you a copy of their return.
Mhm. So now I want to go back really quickly. You said tax preparers should all have is that a P10?
Yes, it's a P10.
Okay.
Mm-hmm. And it's a personal tax identification number, is what it stands for.
Okay. And so if your tax, say you've worked with the same person for the last 3, 4 years, and when you ask them, somebody has watched this video and learned that, okay, I need to ask for a P10. Oh, well, I don't have one of
Hmm.
those. What should we do?
Run.
Uh-uh. Okay. Okay.
But I think I mentioned to you, or I know that I posted that
Mhm.
the annual filing season program, and that's something to where it's not mandatory, it's actually voluntary, but it actually sets you apart from other PTN holders. So with me being a part of that, I can
Mhm.
actually go before the IRS and I can represent you, but it's limited representation to whereas someone who just has a P10, they are only responsible for filing your taxes. But also ask them about the prepare about the Circular 230. The Circular 230 is the Bible for tax preparers, and so that
Okay.
will let you know what your tax preparer is actually responsible for.
Okay. And I know we will also want to make note of the fact that you said get a copy of everything that is being
Hmm.
submitted to the IRS on your
Hmm.
behalf. So that means the
Yes.
entire package, not just those first two pages that tell you what your refund is supposed to be.
Yes, because there are actually schedules in there, and in particular, there's a schedule 3. And
Hmm.
on that schedule 3, it can tell you whether or not, someone actually filed something that was fraudulent on your return. For instance, this fuel tax credit that a lot of people were placing on taxpayers' refunds
Hmm.
or taxes in order to increase their refund.
Oh
And
wow.
it should not have been because it's pretty much for farmers. It's not for on-road trucking companies, and a lot of them were putting that on there to actually increase the refunds. They were putting solar credits on people's taxes, and I don't know of too many people, that I actually deal with that actually has solar panels on their houses. So just make sure that you're actually asking questions to your tax preparer when it comes to you filing, and so they can actually be able to explain to you exactly where they're getting these numbers from instead of just putting some numbers on your paper. So as a tax person. Um, I just want to make sure that I educate all of you guys, all of my tax clients, and anyone else pretty much who has a question when it comes to taxes, because like Miss Lydia said, like we have been going for so long and we just been going with whatever, or what we've
Hmm.
been taught or to be correct instead of doing it the correct way. And that's why I come on and I try to educate at least, every day and say something that's going to help you out in the long run when it comes to these taxes, because it's real out here in these tax streets, Lydia.
Okay, look. Listen, I want to thank you so much for your time
Thank
this
you.
morning. Thank you for your willingness to share these facts and this information with viewers. So, if you have just now tuned into Wealth Building Wednesday, honey, we have had 30 whole minutes of tax information. When I tell you, go back and
Yes.
listen to all of these things. And some folks, you may want to take notes because if you may have been engaging in some practices in the past that could eventually get you in trouble. And the goal of this opportunity for us to talk to Tiffanie this morning is to make sure that we're equipping people with the right information, making sure that you're not walking in just looking at the dollar signs. I know the comma in the number can
Right.
sound and feel like something you want. But at the end of the day, what we don't want you to do is to end up incarcerated or have to face an audit or losing benefits because you're just going along, with what has been done in the past. So we are excited and thank you. We're so grateful to you for being able to share these 30 minutes with us.
Thank you for actually inviting me because, like I said, we do need to be educated when it comes to these taxes.
Absolutely. And so we look forward to having everyone back next Wednesday, 10 a.m. for Wealth Building Wednesday, right here. So wherever you are tuned in, come right back here next Wednesday at 10 o'clock a.m. for Wealth Building Wednesday, where we will have another expert talking about everything money. Y'all have a great rest of your day.
You do too. Thank you for having me again.
Absolutely.